Good evening, everyone. Am I audible? Just check.
You're audible. You're audible.
Yes.
Yes.
Today we are associated with DHRUVA Advisors. It's our. It has been a long time. We have been conducting TAXSCAN webinar series with associating many professionals in the different parts of. Just a moment. Hello. Hello.
Yeah, you're audible.
Yes. Yeah. I would like to introduce partner Mr. Ranjit Mahdani of DHRUVA Advisors and the two principals, Mr. Rudraj and Kulraj. They have been taken the discussion of dealing issues of input tax credit today. I'm not looting more time to for welcoming all the participants and the panelists. I'm taking control to the panelists for further continue the discussion. Over to you, Ranjit.
Thank you, TAXSCAN team, for having us over on today for a very important topic of the GST law. Firstly, hello and welcome to our participants on this webinar. Good evening to everyone. We are actually quite awed by the number of participants we have today, which just showcases how crucial this topic is. The goods and services tax, input tax credit matters in the business environment that we operate in and the sort of commercial environment that we have. That input tax credit is a cornerstone and the sense of GST system. And this has been said time and again. So we have the statements and objects of reasons which accompanied the Constitution Amendment Bill, which when introducing the GST regime and a little before that as well, emphasized that there would be a seamless transfer of input tax credit from one stage to another in the chain of value addition. Even the Organization for Economic Cooperation and Development, the OECD, emphasizes the main characteristic of a value-added tax, which the Indian GST is for preserving the neutrality in the value chain. Therefore, how do you achieve the neutrality in the value chain? How do you ensure that there is a transfer of the credit from one to the other and it's available in the extent that it is should be to maximize and have a neutrality on the value chain is by input tax credit. And therefore, what we are having to deal with on a very regular basis as taxpayer, as professionals, as the department is the provisions which concern input tax credit and a lot of issues which arise around it, whether it's from the interpretational point of view or it's the mindset that the revenue authorities have. And as taxpayers and professionals, there is a constant dialogue with the tax authorities. So issues in the GST law, which are concerning ITC, are inevitable. We are facing this on a regular basis. And so we propose to share today with you our thoughts over the next 1 hour on what is the contemporaneous issues that are there in the ITC environment. What is it that the positions one may take? How does one analyze these sort of issues in their own business structures is what we're going to go about discussing today. Our presentation today is going to begin with the recommendations which the GST Council made last week. We are focusing only on the ITC pieces and not the others. We're going to talk about thereafter some of the do's and don'ts that are critical from the September timeline, from the September 30th September timeline, because that date is upon us and there are various tasks that one must do as a taxpayer to ensure that there is compliance and to ensure there is complete enjoyment of the credit that would otherwise be lost out. We then wish to take you through the variety of issues that are there in input tax credit, where we will deliberate upon the issues and points that have emerged in respect of different sort of situations, different sort of questions that have come up over a period of time. And Rituraj, Kulraj, and I myself will share our experiences as we've gone about in the last 4 years, sort of dealing with those sort of issues in the ITC space. We'll end the session today with a Q&A phase, and we'd encourage you at that point in time to raise your questions, whether in the chat box or by speaking it out. It would be something we'd look forward to as well. So now, without taking any further time, I'd like to request Kulraj to first talk about the ITC recommendations, ITC related recommendations that the GST Council made at its 45th meeting last week. Thereafter, I'd request Rituraj to talk to us about the important do's and don'ts, bearing in mind the September timeline that we have just around the corner. Kulraj?
Sure. Thank you, Ranjit. I think Rituraj, can you place the presentation again? Yeah, can we proceed to the next slide, Rituraj? Perfect. Thank you. So, good evening, everyone. The first issue, as Ranjit mentioned, that we'll be talking about from the recommendation of GST Council, and there were enough and more recommendations from an input tax perspective as well, which has been relevant from the taxpayers, and taxpayers were looking for some kind of clarity on those issues. The first one, that is the most critical one, is the timeline for taking credit on debit notes. So, till last year, there were debates upon, because GST law has a restriction to issue credit notes, but there was no restriction to issue debit notes, so debit note could be issued at any point of time. And therefore, there was a debate around whether credit on such debit notes can be claimed later, belated or not. And Section 16(4) had a restriction to it, and it said that the credit on invoices and debit note pertaining to such invoices can be claimed till September of the previous financial year. Therefore, while there was no limit on payment of tax on debit note, but there were restriction to claiming credit on the same. This led to disputes, this led to uproars among the industry people, which said that there is a cascading that is developing. There is this credit blockage that is happening, because credit on debit note cannot be claimed, while the supplier would recover it from recipient, and recipient would have the inability to claim the credit. And this led to a change which was recommended and which got into effect from 1st of January 2021, wherein it was said that the date of debit note gets delinked to the date of invoice, and Section 16(4) was suitably amended. Now, there were again debates about it, whether the amendment shall do away and what is the impact of such amendment. Surprisingly, there was in Gujarat AAR which said that debit note shall always take color from the invoice. Therefore, debit note cannot be looked into a standalone document. It has to be linked to the invoice, and the amendment shall have no implication. This led to again uproar among the industry people, whether date of debit note is relevant, date of invoice is relevant, and so on. So GST Council, in its very wisdom, came out with a clarification saying that date of debit note shall be relevant for determining the credit, and therefore any debit notes on which credit has to be claimed from 1st of January 2021 onwards shall be claimed on the basis of date of debit note, and the date of corresponding invoice shall not so be relevant. And this is so important because, in a lot of industry segments, we have seen that debit notes being raised for the past years, and even for 17-18 getting raised in 2021. So now, if you have any debit note on which you want to claim credit post January 2021, the date of invoice shall not be of relevance. It is only on the date of debit note. However, it also to be seen that every invoice as debit note now will have a time limit. So for every debit note, you need to see whether you need to take credit within the specified timelines only. So while there's a liberty to claim credit on debit notes, but yes, the timelines on debit note should also be important to see. Next. Again, a much needed amendment is that there were cash ledger balances in the taxpayers' ledgers, wherein there was provision that any balances in cash ledger can be claimed as refund. But yes, the refund process involved a timeline, involved dealing with the department, filing of application, and so forth. So again, GST Council recommended that cash ledger balance from one GSTN to another GSTN of a taxpayer can so be transferred. So therefore, it will bring more synergies into the system wherein the amount has been there in the cash balance. The mechanism has so not been notified as yet, but yes, it shall amount to a huge relief wherein the cash ledger balances are there and that can be utilized by other GSTNs of a taxpayer. Next, again, is important recommendation that the council has suggested. So as you must be knowing that there was this amendment that got into effect in under Rule 59.6, which said that a taxpayer, if do not furnish GSTR 3B for 2 tax periods, will not be allowed to furnish GSTR 1. So therefore, there was a restriction on furnishing of GSTR 1 if a summary return in 3B and tax payments are not made. Now, this was 2 months. Now, the GST Council has recommended that the rule be amended and the restriction be made to 1 month only. This again will have an implication, but will bring the entire credit mechanism to sync. The entire objective of government to ensure that the supplier files the return, the recipient takes the credit through a mechanism will get more effective with restrictions like this coming into place. Next. A very, very important amendment that the council has so been suggesting and recommended that if you must all be knowing that the Finance Act 2021 had made a change, had brought an amendment to Section 16(2)AA that got introduced. Section 16(2)AA specified that as a condition to claim a credit, it has to be ensured that the supplier furnishes the statement of output supplies and that gets communicated to the recipient. So therefore, it said that the only credit which will be available is one which has been uploaded by the supplier in GSTR1 and gets communicated to the recipient. Now, GST Council has recommended that post Section 62AA will come into effect while it has been notified by the Finance Act 2021, but the date of notification has not been announced, so it is not effective as yet. The Council recommended that post Section 16(2)AA comes into effect. Rule 36(4), which provides for restriction to claim credit, should also be suitably amended to provide that credit shall only be available on invoice which gets uploaded through GSTR1 and communicated to recipient through GSTR2B. So therefore, it makes while the amendment made a very, very important change because there were disputes around validity of Rule 36(4) only, whether it is it has a legislative backing or not. So while it brings a legislative backing through 16(2)AA, it will get amended. Another controversy get resolved, which was usage of credit through 2A or 2B. As per the proposed amendment, the credit will be available to 2B only. This brings us to an important question that if credit gets entitled through GSTR 2B, what shall be the relevance of 2A as a form? In our view, 2A will still be relevant because 2A is a dynamic form. So from a vendor reconciliation perspective, from a vendor sanitization perspective, 2A shall still hold relevance, while 3B shall going forward be the form for taking credit. So for everyone here and the larger community, the government has trying to bring it an important distinction now between 2A and 2B, and it said that 2B shall be the right form for taking credit. 2A will still remain and can be used by the taxpayers for vendor sanitization, vendor correlation, because it's a dynamic field and changes regularly. Next. So with this, we come up with a poll question for everyone, and can we have the poll running? So the poll question, which will be in the front of your screen, is an important one actually. So interest on ITC wrongly availed and utilized is payable at what rate? 18% or 28%? You will have one choice to make, and we request everyone to have their choices, please.
Kulraj, hope you are able to see the poll answers.
Yes, yeah, we have. So can we see the poll results, please?
Yeah, I'm ending the poll now.
Yeah. So a large part of the believe that interest is applicable in 18%, while there is still a lot of people who believe that 24% is one touch tax rate. Now, there was a lot of debate about 18 and 24 as far as this regime is concerned. So can you just end the poll, please? So this resulted into department invoking demand seeking 24% under Section 53 of the CGST Act, which stated that interest in case of undue or excess claim of credit under Section 42 or 43 shall be payable at 24%. Now, 42 or 43 provided for a mechanism of credit verification through GSTR1, GSTR2, which never got introduced. So there was a debate whether Section 53 actually has a legal validity or not. While department was invoking an interest on 24% on input tax credit excess or undue taken, the taxpayer were contesting it on the basis of a validity of the entire provision only. The council has now recommended that interest Section 53 should be modified, and interest shall be payable at 18% on credit availed and utilized. Now, this gives a lot of respite. This gives a lot of hope that the entire issue of the interest being sort of 24% gets away done. More importantly, what the GST Council has done is that it has recommended that this amendment shall be made retrospectively, and that is the right way of doing it, because 42.10 and 43.10 are so not applicable. So they have recommended a retrospective amendment only to Section 15.3 for credit availed and utilized. This again brings up to an important question that the council is of a considered view that interest shall not be a claim on credit only availed, but it shall be on credit availed and as well as utilized. So therefore, both conditions have to be mutually satisfied. This brings up to an important question for us is what happens if the interest has been so paid in 24% in any of the past proceedings, whether a taxpayer is entitled to claim a refund of the interest so paid or not. In our view, interest shall so be eligible. Section 54, which talks about refund, talks about taxes and interest. So if you have paid, if this amendment gets notified, if it gets notified at a retrospective impact as suggested by GST Council, then taxpayers would be able to claim a refund of the excess interest paid. However, that should be subject to proving that the interest component the burden of interest has not been so passed to the third person. So therefore, the entire concept has to be proved that the burden has so been borne. So unjust enrichment is a concept that will come into picture, and we need to see what kind of documentation would then be required. But yes, it's an important event. It's a welcome change that has been done by GST Council. Reduction of interest is always important, and a clarity whether it is 24% or 18%. We are likely that government may bring up something. If not, then an interest would always be applicable for a taxpayer. With this, I'll hand over to Rituraj to take over the next session on the key to-dos for financial year 2021.
Thank you, Kulraj. Good evening, everyone. Now we'll be talking about the key to-dos for the year 2021. For all the indirect tax professional on the webinar today, if I ask one question, that what has been the key to-do list for you in your agenda or in your to-do list, I'm sure all of you will tell me that September return related action points has been topping your agenda. And rightly so, because for the year 2021, the substantive benefits like availing input tax credit or reduction of output liability, the timeline for year 2021 end with the month of September. Therefore, before we file our GSTR1 and GSTR3B for the month of September, there are a host of activities that have to be taken into consideration. If we have to look at the activities that we need to take care of, they can be basketed into 4 categories. Firstly, availing input tax credit, or if I may say, availing missed input tax credit pertaining to year 2021. The next action sets will be around reversal of input tax credit for the year 2021. Thereafter, coming to the outward side, the list of actions, one of the key actions which we have to ensure when we file our September month's return is to make sure that all the credit notes which are unreported or all the credit notes which are yet to be issued have been completed with and are factored at the time of filing GSTR1 and 3B for the month of September. And lastly, whatever are the corrections to be done as an overall basis, in order to take care of any errors or omission which may have occurred during the monthly returns, those need to be taken care of. Now, before we get into the specific action points for each of these items, we have one more poll for the participants. Can we have the second poll question, please? Yeah. So the poll on your screen is, on what basis are you availing input tax credit? Is it on the basis of GSTR 2A, GSTR 2B, or on the basis of invoices, which is basically your purchase register or books of accounts? I think audience, the participants would have voted. So can we have the poll result also? Okay. So maximum percent of ITC is being claimed on the basis of 2A. Then we have credit which is being claimed on the basis of invoices, and lastly on sorry, 2B is the maximum number and 2A is on a lower side. This I think shows sort of representation of what has been happening in the industry when we go for taking credit. There are divergent practices which are being followed and multiple ways in which credits are being availed. Now, coming to the key action points as far as availing input tax credit is concerned, the first and foremost activity that we need to do is to identify what are the missed credits for the year 2021. And in order to do that, there are several steps which can be taken. First of all, undertaking a reconciliation between books and the GSTR 3Bs that have been filed is a first step. Typically, you would know that this is something which is done at the time of filing GSTR 9C and the annual return. But it is also crucial to do this activity right now so that we can identify what are the credits which are there in books but not in returns. There are several times it happens that invoices get booked in the system, but credit is consciously not taken for multiple reasons. It could be because the payment has been kept on hold because of some dispute, or the GRR has not been completed, or the inspection of goods has not happened, or there could be multiple reasons why credit may be there in books but yet not availed in returns. So it is important to identify such items and make sure that credit of that is factored when we prepare our GSTR 3B workings. Next in line is to undertake reconciliation, or I would say complete reconciliation between GSTR 2A and 3B. I'm sure most of you have been struggling to complete the activity of 2A reconciliation. I think it's extremely complicated, but absolutely vital to do that activity. If we look at what is coming out of the 2A reconciliation, is essentially we get two sets of findings. One is credit, which is there in your 3B, but not in your 2A. And second is credit, which is there in your 2A, but not yet in your 3B. Now, for the first set of credit, which you already availed, there is no action to be taken as far as GSTR 3B of September is concerned, but there'll be a lot of actions which are must as far as vendors are concerned. So one, we need to identify vendors from whom the invoices have not yet been reported, and that's why not reflected in GSTR 2A. Communicate the list of invoices to specific vendors. Also do a sort of ABC analysis in vendors to identify which are the vendors who will eventually report the invoices in September return and who are the ones which will not report the invoices. And especially with the defaulting vendors or probably defaulting vendors, a special course of action will have to be taken, wherein I'm sorry, I think I had lost. There was some error in my connection.
It's fine now. It's fine now, Rudraj.
Yeah, are you able to see the screen?
Yes, yes, yes.
Okay, so as I was saying that as far as the set of credit which is there in GSTR 2A but not yet availed in GSTR 3B, this is again a very important area which needs to be looked at carefully. If you look at GSTR 2A, there could be several invoices which will appear in 2A, but credit of that may not have been taken. So it could be because the service is ineligible in nature, like a rent-a-cab service, or it could be erroneous reporting by a vendor and that invoice doesn't belong to you at all. That credit obviously has to be ignored. But there could be other set of credit which are legitimately your credits, but may not have yet been booked in your books of accounts. The GRR may not have happened, or these are inputs or input services which you have availed through an agent like a airline agent or a CHA agent, where the underlying supplies may not have been booked in your purchase registers. Or it could be a bank credit which generally comes in 2A but is not there in purchase register, and that's why it gets missed out. So all these scenarios have to be very carefully evaluated to identify whether there is any credit which is eligible and not has been claimed, and accordingly appropriate corrective actions will have to be taken. Now, another area and a very crucial area from a ITC action perspective is to revisit the taxability positions or eligibility of credit positions those have been adopted. What we have noticed across all the GST audits and reviews that we undertake is that the eligibility positions have been taken at the time of GST implementation, but the GST law has evolved thereafter. There are a number of interpretations which have come in through AR mechanism, and the positions are actually possible to be altered. Just to give you an illustration, for the year 2021 particularly, medical insurance was something which had become mandatory in the light of COVID pandemic. This is one credit which by and large is not availed. But for the year 2021, there is a possibility of exploring whether this credit can be availed. So this was just an illustration, but in that manner, there is a possibility of revisiting the checking whether there is any credit which can be availed. One more important point for importers of goods is that undertaking a reconciliation with the IceGate data. This enables you to find out what are the shipping bills, what are the bill of entries which are there on which you have paid duties, and you can cross-check whether credit has been taken in respect of all the bill of entries. This is one activity which is not necessarily done, and if there is any missed credit, then there is a possibility of availing that credit. So corrective actions as far as ITC is concerned could be A, availing short avail credits, reversing excess avail credits, correcting accounting entries, and also taking corrective actions as far as the defaulting vendors are concerned. Now coming to reversal of common credits, everyone who is into a supply of taxable as well as exempt goods or services is required to undertake a reversal in terms of Rule 42. As you would know, this reversal has to be done on a monthly basis and also at an annualized level. And at the time of September return, we need to compute the total exempt supplies for the full year, total common credit for the full year, and recompute what should be the 42 reversal amount. And if the reversals which have happened so far are less or more, then corrective action can be taken. Here, one point I would like to specifically mention is that what is being considered as exempt supply also needs a careful consideration. What happens is that number of times exempt supplies like interest or high C sales or bond sales, which are not required to be considered for the purpose of 42 reversal computations, are considered as exempt supplies. Similarly, at the same time, exempt supplies like sale of mutual funds or sale of MEIS, SEIS scripts, which are actually exempt supplies and which have to be factored for purpose of 42 computations, are not factored. So looking at what is being covered under the exempt supply is also very, very important. And we have an opportunity to relook at our reversal workings and correct them in the time of filing GSTR 3B. On the outward side, like I was mentioning, very important to note that any liability for the year 2021, which we need to reduce, this is our last opportunity. So very important to identify which are the credit notes which have been issued but not yet reported in the GSTR1. In order to identify that, reconciliation needs to be undertaken with books. So the sales reconciliation with books to identify which are the credit notes which are already issued but not reported. Secondly, we also need to identify which are the scenarios where credit notes are required to be issued. So for example, it could be cancellation of sales, cancellation of invoices, revision of prices. All these scenarios may require you to issue credit notes. If at all that is required, the time for that is now. We need to issue credit notes and report them and effectively reduce the output liability at the time of filing GSTR 3B. Last step is basically a culmination of most of the things that we spoke about, which is overall corrections. So the returns for the month of September, which is GSTR 1 as well as 3B, gives us an opportunity to rectify any incorrect or any incorrect reportings or omissions which may have happened. So in order to do that, what is required is that, as I mentioned earlier, we need to undertake a reconciliation to identify any missed reportings. One thing which typically happens is that while everything which is there in your turnover from operations, your sales GLCs, get reconciled with the GST returns, but whatever is there in your other income at times get missed. So there could be certain exempt income in the other income or certain taxable income in the other income, which at times get missed to be reported in the GSTR 1 or 3B. Therefore, it is very essential to undertake a reconciliation with the other income also to find out whether any supplies have missed to be reported. Also, as I was talking about the revisiting taxability at the time of input credit, similarly, for outward also, there is an opportunity to identify whether any of the tax position needs to undergo change in the light of legal changes or judicial developments which have happened over the course of last 2-3 years. So just to give a couple of examples, taxability of employee recoveries. By and large, most of the organizations have been paying GST on employee recoveries, let's say canteen, transport, which are done from the employees. Also, GST liability is paid on penal charges, which are recovered from, let's say, vendors or employees also. There is a possibility of looking at or re-looking at that position in the light of different ARs which have come in to check whether we really need to continue to pay this liability. And if not, there is an opportunity of reducing liability and making corrections at the time of filing GSTR 3B and 1 for the month of September. So that's it on the actions that we need to take from the for the year 2021. Now we can move with our main topic, which is dealing with the critical issues on the input tax credit side.
Thanks, Rituraj. Thanks, Gulraj. I think this is perhaps the more exciting piece which everyone was looking forward to. So let's dive right into that. And let's go to the first topic that we want to explore is input tax credit for CSR expenses or COVID expenses. Okay, a burning issue in these pandemic times, and as you just mentioned a couple of minutes ago, and the issue that comes up or the question that gets posed every now and then is for such expenses, can input tax credit be claimed? We have to bear in mind that oftentimes or in many situations, this is mandatory expense. It is under some regulation or some compulsion that it is incurred. And in some situations, it may not be so, and it may be voluntary. Now, are these to be outrightly disallowed, or there is a ability to make a claim for these credits? Rituraj, would you just explain some of your thoughts on that?
Yeah, sure. So Ranjit, as we have seen in the pre-GST regime as well as now, that there has been an ongoing debate on eligibility of credit as far as CSR expenses are concerned. Even in the pre-GST regime, this was a bone of contention between the service tax authorities and the taxpayers that whether input tax credit can be claimed. For the pre-GST regime, in case of SL Propack, the Mumbai Sestat had given a favorable view wherein it was acknowledged that CSR activity is a mandatory activity for the organization. This is in a way essential for it's one of their statutory obligation, and if they do not undertake this obligation, it will have an impact on their sustainability itself. And therefore, taking credit is also important, considering expenses undertaken for CSR need to be considered as a legitimate expenditure, and hence credit should be allowed. But in the GST regime, as we are seeing, is that there are divergent views, favorable as well as unfavorable. For example, in case of polycab wires, the Kerala authorities had said that free distribution of goods under CSR activity will not be considered as goods eligible for input tax credit. Similarly, fairly recent judgment on this particular topic in case of Adama India, wherein the Gujarat AR also had a similar view, wherein it was said that any input services which are used for CSR activities, the credit should not be eligible. At the same time, we have a very favorable and rather very detailed out AR ruling in case of Garikesh Sugar Industries by the UP AR, wherein it was again factored that CSR is a mandatory activity, and that's why it is undertaken in the course of furtherance of business, and hence input and credit on such expenses should be allowed. This particular AR also factored that when you supply or when you distribute goods as a CSR activity, that cannot be equated with gifts. And that's why the limitations or restrictions as per section 17(5)(h) should not be applicable. So fairly speaking, as far as the mandatory CSR activity is concerned, I think it could be possible to say that credit is available, and there are more grounds to say that the credit can be defended. But when it comes to voluntary CSR, that could be more contentious, as establishing a link with the business will be more difficult. Another topical expense, which I think most of the organization had to do in 2021 and 21-22 also, not necessarily under CSR, but for their own organization, was expenses related to COVID. Now, if we look at the COVID-related expenses, most of the organization have spent or incurred expenses on 3 or 4 types of categories. One is on consumables like masks, sanitizers. Second is on items like oxygen concentrators. Third is some of the organizations have arranged vaccination for their employees and their families. And fourth is some organizations have undertaken expenses for enabling work from home. So for example, products like sound cancellation headphones or laptop risers were given to employees on a non-returnable basis. So there are different expenses which were done as a part of COVID expenses. Now, to determine eligibility of such expense, I think it has to be looked at from 2 fundamental angles. One, can I say that these expenses were undertaken as a part of or in course of business? And 2, are these expenses limited, or are these expenses restricted by any of the provisions of the ITC regulations? Now, in that regard, there's one Supreme Court ruling in case of Malayalam plantation, which is very relevant in that sense, in which case it was held that any activity which is undertaken for protecting assets of a business should be considered as activity done in course of business. Now, if we have to draw analogy from that judgment, it can very well be said that all these expenses, be it on masks, vaccination, sanitizers, which were done, are for preventing employees of the organization from the pandemic, and employees being very crucial assets of the organization. This activity is very well done within the course of business. At the same time, there is a possibility that GST authorities may take a view that any inputs used for personal consumption should be not eligible in terms of section 17(5), And that's why all these masks, sanitizers, vaccination, in a way of speaking, is something which was consumed personally, and hence the credit should be denied. Now, arguments can be taken against this particular logic also, saying that not providing these supplies will have an impact on the continuity of business itself. And if the employees are not able to work, it will have a direct impact on the business, and hence it cannot be said to be a personal consumption. So I think in times to come, we'll definitely see a more litigation and queries on these type of expenses, but it would be fairly possible to defend any credits which have been taken on these lines.
Thanks, Rituraj. I think you covered a lot of ground and a variety of situations that we have had, whether it was CSR or whether it concerns the COVID-related expenses. Maybe connecting onto another point and topic, which is input tax credit on construction. Again, a fairly controversial aspect of the ITC provisions. And I think that controversy has carried forward from the pre-GST regime as well, where everyone in respect of MODVAT and CENVAT will be able to recollect the kind of disputes that were there, the amendments that were made to law from time to time. Now in the GST regime, Rituraj, we are also looking at a decision from the High Court in Safari Retreats, which quite simply put looks at the law in a fairly objective manner rather than in its literal words. What is your sort of thoughts and points on input tax credit for our participants today in respect of construction related activities?
So if we look at the GST law, section 17.5C and section 17.5D explicitly disallow input tax credit, which has been taken or any inputs or input services which are used for construction of an immovable property. In case of Safari Retreat, this very restriction was contested, and it was said that this particular restriction is unconstitutional. In the Orissa High Court, they already read down these provisions and said that yes, these are not constitutional, these restrictions are incorrect, and hence credit should be admissible. Now we are all waiting for the Supreme Court verdict on this judgment. Apart from that, there are a number of other courts, including Bombay High Court and Punjab and Haryana High Court, Gujarat High Court, where on similar lines, the constitutional validity of these restrictions have been challenged. So we really will have to see how the Supreme Court reviews these provisions, and whether the Supreme Court also believes that these are not in the spirit of GST law and they are in a way contradicting the very premise of the GST law. In meantime, what we can see, what is happening at the AR level is that all the ARs that we are getting are on a negative side. By and large, the input tax credit on construction activity is being denied in the AR, and while they are referring to the ruling of Safari, they are also saying that since it is challenged and the appeal has been admitted at the Supreme Court, pending that, all the rulings that are coming in meanwhile are all negative. Now, if Supreme Court has to uphold what was held by the Orissa High Court, that will come up as a relief for not just suppliers who are into leasing of immovable property, but it will be in a way positive change for all the suppliers, be it manufacturers or service providers, because all of them have to avail services of construction in some way or the other. Having said that, till the time we have a ruling from, we have the judgment from the Supreme Court, it would be absolutely litigious to take any input tax credit on the construction activity, because this has been very, very litigious. What we are seeing across industry generally is that input tax credit on construction is not being availed. A connected point to that is that when we do a lot of GST reviews and audits, one thing which we have noticed is that any expense which gets accounted into the land and building expense category, generally credit on that is not taken. but there could be a possibility that an expenditure is in the nature of civil works and it is getting grouped or accounted in another expense category. For example, in some of the cases, we had noticed that immovable property input services like construction of a road, construction of a boundary wall, or construction of a parking for that matter, is something which was accounted or grouped in the plant and machinery account or expense head, as a result of which input tax credit was taken on it inappropriately. So what is very important and crucial for everyone to note is that we need not be blindsided by the manner of accounting, and what we need to check is that any item which has an element of civil works to it, we need to look at it carefully. We need to check whether it is in the nature of new works or is it repairs, whether it has been capitalized, not capitalized, and on the basis of that, take a conscious call about eligibility of credit on it.
Thanks, Raj. Kulraj, turning to you, my view is that all amounts that are spent for and by a business and effectively charged out to the profit and loss account should enjoy credit. I mean, it's a simple, thought process. It exists in even the income tax law. So do talk to us about the input tax credit that one should take, not take, in respect of business promotion expenses, in respect of gifts, samples, maybe if that's also something that can be, bunched with this set of issues. If you could describe your thoughts on those.
Sure, Ranjit. So rightly mentioned that if you look rationally, credit on all business promotion expenses should be done because these are absolutely essential for promoting sales. However, Section 17(5), which provides for ineligible credit, starts with the fact that notwithstanding the fact that they're used for business purposes, credit will still not be allowed. And it covers two important categories: is gift and free samples. So therefore, any expenditure which is other than the color of gift and free sample is permissible. However, important is that gift and free sample, there's a specific restriction of the law. So I would believe that credit out gift and free sample is specifically denied, so will not be available. But this brings us to a larger question that what exactly is a gift? And that's what been a dispute before several advanced ruling authorities. So if you look into the definition of gift, that's not there in the law, but in a normal parlance, gift is something that is given voluntary and has no monetary consideration. So anything if I offer without any kind of commitment is a gift. It's my own free will. If any such expenditure is done, let's say I throw away T-shirts to people on the road, or probably in my distribution chain, I give let's say gold coins to my customers or gold coins to my distributors. It's about a free will. I'm doing it voluntary without an obligation. So in all such cases, it constitutes to be a gift, and therefore credit is an issue. But if in cases where there is a condition to it, let's say I throw up incentives basis schemes which I give it to distributors. Let's say buy more than this quantity and I'll give a gold coin. In all such cases, this is not voluntary; it's a conditional thing, so should not qualify as gift. And therefore, in all such schemes, credit should be eligible. And that's what is an important differentiating point, which everyone has to, every business has to see what is a gift and what is not a gift. When we talk about sample, it's pretty much a clear analysis that anything given as free sample, which doesn't really hold a consideration, there will be credit restrictions to it. So the important cases is that anything which is other than gift and free sample, absolutely heads on, take a credit. If you are giving anything from a scheme perspective, it's not a gift, credit is available. Anything in typical nature of gift would be a restricted item under 17(5), and credit will not be available on that.
Thanks, Kulraj.
Yep.
Rituraj, we've heard a lot about manufacturing activities concerning goods, where there is some or the other form of a loss. This is a process loss, to put it in a simple term, but it could be normal process loss, it could be abnormal process loss. And in some situations, it could be a loss which is occurring because of a commercial decision which is made, and a sort of compulsion which is brought upon business by itself, meaning that there may be equipment sent out for testing, and then there is a destruction which occurs for it because it's not of any use, or in the testing phase itself, it gets, becomes non-usable. So it's not obviously brought back. whether or not credit in all these situations, whether normal loss, abnormal loss, items that are sent out and not brought back, credit can be enjoyed?
Yeah, this is a very very topical point. If I look at the GST law provisions, and especially Section 17(5)(h), it talks about credit restriction where goods have been lost, destroyed, or written off. In respect of such goods, credit should not be available. Now, if we look at the overall scheme of restrictions, it appears that what is the intention of the law is that any goods which have been lost, destroyed, and because of that, they were not able to be used for the business operations, credit in respect of such inputs should not be admissible. So for example, if I brought in raw material, I have paid GST on it, I availed credit, and before I could apply that raw material for my manufacturing activity for further supply, the raw material was destroyed. In such scenario, it will come under Section 17(5)(h), and the credit on that will be not available. On this particular point, there is no 2 point. But whether it is correct to put all the type of loss or destruction of goods at par, as you mentioned, that even as in the course of normal manufacturing process or any business operation, there could be number of scenarios where goods may lose their existence, the goods may get destroyed because they have been applied or because they've been used as a part of certain process. For example, there could be situation where goods may get destroyed as a part of testing, goods may get destroyed during the manufacturing process, which is what we call as a normal loss or consumption, or manufactured goods, fully manufactured goods may get destroyed on account of some issue. So whether all these destruction or loss of goods, whether it can be looked at par, or there has to be a distinction which needs to be carved out. Now, very interestingly, in the pre-GST regime, if we see, there have been number of cases which have said that for consumption, for any normal loss, you need not reverse your input credit. But very, very recently, in case of a Gujarat AR for Kanhaiya Balwani, it was held that any loss of manufactured goods, so if the manufactured goods are destroyed, input credit needs to be reversed. I'll I'll talk about the facts a little bit more in this case. So in case what had happened was the appellant was, or the applicant was into manufacture of cakes and pastries, perishable items. And the normal way of operation was that the manufacturer or the supplier would supply these pastries and cakes to the distributors, the cake shops, under cover of an invoice on payment of GST. And the cake shops would display those pastries and cakes. Now, cakes and pastries being a perishable product, if they are not sold within a certain timeline, obviously they cannot be sold. There are restrictions, there are laws which prohibit sale of perishable goods beyond a certain point in time. And that's why the such goods which have not been sold beyond expiry period are returned, and the applicant who was claiming credit was filing credit notes and getting the liability reduced. And these cakes or pastries used to come back and they were simply thrown off or destroyed. Now the question was whether any reversal is required in case of such transaction. Very surprisingly, the Gujarat AR has held that this activity of destruction of manufactured goods which were supplied and have returned back 5H and input credit is required to be reversed. Now, this brings us to a question that are we really expected to put all the loss or in the same lens, or we need to carve out a distinction between goods which have been applied for processes in the course of furtherance of business and the ones which have lost as such. So this is something, this is an area where we will, I think, see more litigation in times to come. But for a process loss or goods which have been applied for furtherance of business and then lost, I think there's a fair chance to say that such credit should not be reversed.
Fair enough, George. Kunraj, taking up the next topic, the ITC law, the provisions concerning ITC in the GST law, they're particularly focused on not allowing credit that has a personal element to it or is related to personnel. So whether it's canteen facility, transportation, creche facilities, what is the position on these, set of types of expenditures? Would we be able to take credit? Is there a overarching ability to do it by virtue of some other provision? Could you just throw light on some of those aspects?
Yeah. So so the 17.5 has specific restrictions over expenses like outdoor catering, food and beverages, and so on. So when the GST law got introduced, the restrictions were in place. So irrespective whether these are business expenses, there was a restriction. However, in February 2019, two provisos were introduced in the law, wherein a proviso, which was an overall proviso to 17.5.2, said that any expenditure which is obligatory to be incurred by an employer or to be a taxpayer would be allowed as credit. However, the dispute was the placement of proviso was overall to the entire provision, not specifically towards the restriction that was brought in outer catering service. So there has been a dispute whether any expenditure of statutory nature, which is an obligatory nature, can be claimed as credit or not. In our view, the proviso, the placement of proviso is irrespective. Credit should be available even if an expenditure is on account of a statutory obligation. These could be canteen facilities provided under the Factories Act. These could be specific state regulations which provide a mandatory transportation facilities to employee from office to home and vice versa. So, but yes, surprisingly, there have been two ARs which have held that only on account of placement of proviso and possibly use of colons and semicolons to say that the proviso is not applicable to that very restriction. It is applicable to the other restriction which talks about the leave travel expenses of employees, which apparently doesn't really look to be true. So in our view, credit is available on all expenses of related to employees which are statutory is liable to be incurred, specifically canteen, transportation, etc. If there is no statutory obligation, if canteen is provided generally, then the credit should be restricted. And same holds true with medical insurance. So there are ESIs, employee state insurance policies, which has to be taken for the factory employees. So because there's a statutory obligation, credit will so be available. But if there are insurance that are done for the employees working in an office space, not in factory, and those are general medical insurance, then the credit admissibility gets disputed.
Right. Let's take the next slide. Yeah, we have a poll question. TAXSCAN team, can you run that poll? Have you faced ITC challenge on account of non-payment of tax by a supplier? It's a yes/no question. Can we look at the result of that poll? So an overwhelming majority, as we would have expected, have faced some or the other challenge on non-payment of tax by the supplier, and therefore impact on your own credit. And that brings us into the next set of points that we're going to discuss, which are connected to this point. And therefore it's again a raging controversy on the position of the supply receiver in respect of his claim for ITC, where the supplier does not pay tax, fails to pay tax, or fails to pay tax in a timely manner. What is the stand one can take? What are the developments on this point? Kunraj, Jituraj, can you throw light on these aspects in a sequence on those points?
Sure, Anjit. So again, a restriction which ideally talks about the commercial aspect of a transaction, and whether GST has anything to do with the commercial aspect is a larger dispute. But given that the law is it? So the second point of a debate is that the entire concept, when was introduced, it was a complete matching mechanism. GSTR 1 was filed, and 2 should have been filed, and you could have looked into whether supplier has made the payment of tax and so on. In the absence of a mechanism, the larger point is it is an impossible event on the part of recipient to ensure whether supplier has actually paid the tax or not. There is absolutely nothing on the record that can prove that up. So in our view, this entire concept of payment of tax and supplier has to ensure that, and to ensure his credit availability is secured, is to be protected by doctrine of impossibility. A supplier cannot do it in such scheme of things within the GST law as it is. So highly debatable issue in our view, could be challenged and should be challenged, in fact, and has been there as a part of litigation. Several such rulings have been there. So again a slightly different point, but yes, related to it only. So several VAT regimes in the earlier law also provided for similar mechanism. Specifically, Maharashtra had a concept of a similar thing. Delhi had a concept of 2A, 2B. So there were laws in place, similar provisions when similar restrictions when challenged to the recipient were taken up to High Court, and High Court has overwhelmingly held that credit should not be denied by the buyer if he have acted in a bona fide way in making payment to the supplier. In Arise India, Delhi High Court held that. In Thapur and Company, Jharkhand High Court had given a ruling. Madras High Court in Sri Vinayak Agency gave this ruling. So there has been some line of jurisprudence under the VAT regime, which will have its implication when this kind of litigation will come in the GST regime. The similar jurisprudence are there in VAT regime, so this will come as aid to the GST regime. In GST regime, we have one odd ruling, which is of Madras High Court in case of DY Bethel Enterprises, wherein similar demand was raised by the recipient. The High Court didn't dwell into the question whether demand can actually be raised to the recipient or not, and High Court restricted so to say that the supplier needs to be investigated first, and that it left on that. So we're sure that this issue is a major issue faced by a lot of people. Participants here have a majority of them facing this issue. In our view, while a provisioning can be taken, but the taxpayer should need to litigate this on several grounds as we discuss, and we will see some kind of litigations around it in a senior court levels.
Just to supplement what Kulraj mentioned, I think for the 4 years that we have in GST, 17, 18, 18, 19, and thereafter, we have to look at this position maybe differently for different periods. Now, if I look at first couple of years, so 17, 18, 18, 19, in a way of speaking, there was no mechanism, as Kulraj mentioned. There was absolutely no way of seeing whether my supplier has filed his returns or not. And also there was no requirement in form of 36(4), which came only in 2019. So for the first 2 years, even if I have taken credit on the basis of my books of accounts and the credits have not reflected in 2A, or the returns have not been filed by the supplier, there is possibly more points to argue upon and defend that credit, because there was no mechanism, in a way of speaking, to take credit. More importantly, in 2018, there was a press release which was issued, which categorically said that appearance in GSTR 2A is not a prerequisite for you to take input tax credit. So for the first 2 years, there are more than enough grounds to bystand the credit that we have. For the year 1920 and 2021, we saw introduction of 36(4), which restricted the credit to a certain percentage of 2A. So in a way, there was a linkage which was created between 2A and the credits that I'm taking. And now with the proposed amendment, which makes reflection in 2B as a prerequisite for taking credit, it will become more and more important to undertake the reconciliation to find out whether invoices have been reported by the vendor, and very crucial to have a robust mechanism for a reconciliation. But even as on date, if I really look at it, there is actually no mechanism to find out whether my supplier has paid a tax or not. The condition that we are looking at is that the tax should have been paid by the supplier. Now, the only basis as of now, which in a way a recipient has, is to check GSTR 2A. But as we all know, GSTR 2A is generated on the basis of GSTR 1. And there could be several scenarios where an invoice is reported in GSTR 1, but tax on that may or may not have been paid in GSTR 3B. So the amount of liability disclosed in GSTR 1 and amount of liability disclosed in GSTR 3B can be different, and that loop has not yet been closed. So even today, it can be very well argued that there is no mechanism to find out whether this condition has been met or not. And the doctrine of impossibility, as Kulraj was explaining, can very well be relied on for all the years as on date.
Thanks, Rukraj. Let's take the next issue, and I'm sure several people on this webinar are facing it, have faced it, and it's an unfortunate situation to be when the Rule 86A kicks in and applies. But Rituraj, Kulraj, and in that sequence, I would like you to talk about the issues that arise upon the blocking of credit by the GST authorities. Is it a highly potent weapon and an unnecessarily potent weapon? And given situations where it may have already been done for whatever reasons, rightly or wrongly, what are the steps then that a taxpayer can take, should take, to unwind that position and to safeguard its own interests?
Yeah. So if we look at provisions of Rule 86A, at the first blush, definitely they do come across as very, very harsh and a handle with the authorities. So the rule says that a commissioner or a officer below him, but not below rank of assistant commissioner, if he has a reason, then the credit can be blocked and you will not be able to utilize your credit for making payments. Now, while this comes across as a very harsh provision or enabling powers in the hands of authorities, we also need to see the premise in which this rule was introduced. So Rule 86A was introduced to basically keep a check on credits which are being availed on the basis of fake invoices. There were a lot of instances which were discovered wherein fake invoices were issued, or there was actually no exchange of goods or services, but invoices were exchanged and credit was taken on the basis of that. The suppliers had gone missing after issuance of invoice and they had not made payment of taxes, and credit was being availed by the recipient. So basically the whole objective of Rule 86A is to keep a check on possibility of having a fraudulent credit and to restrict that credit. If you look at the scenarios where Rule 86A can be invoked, it typically has, in a scenarios where the supplier is not missing, the supplier has gone missing, it's not present, the documents on the basis of which credit has been taken is not there, the movement documents are not available. So substantiative evidence to showcase that the goods or services have been exchanged are not present. And in such cases is where the authorities can block the credit. Now, this provision is there. We have to deal with that provision. So what the taxpayers need to really take care of is that through documentation, maintain a very robust record so that the eligibility of credit cannot be questioned in the terms of Rule 86A. Some of the tangible actions that can be taken, and most of the companies do take those, but we have to take those consciously in the light of Rule 86A. Is that one, keep records of hard copy records of the invoices. Keep a check on or do a periodic verification of the suppliers. Again, not all suppliers. We can do a ABC analysis of suppliers and keep a vigil on a certain segment of the suppliers to check whether they are filing their returns. The 2A mechanism comes in as a support in this activity to check whether there are any suppliers which could be considered to be defaulting in nature. One thing which not many organizations follow is to do a reconciliation with your e-way bills. This is a very good practice which actually can help demonstrate that there are no supplies which are not having a specific movement or an e-way bill documentation. And as I mentioned earlier, undertaking a 2A reconciliation, maintaining hard copies of the documents or soft copies of the documents in a systematic manner are some of the ways and means or tangible actions which can be taken by the recipients to make sure that if at all authorities have to probe their credits, they have enough and more substantive material on their side.
That's right. That's right. So just continuing to the point which was made by Rituraj, is that what happens if it is done? And that's a larger question that has been before the courts, that it's a suo moto activity which is done by the authorities. So if it is done, then in our view that the taxpayer must immediately go to jurisdictional authority. If there are tangible reasons, then prove the evidence basis maintained by, as explained by Rituraj. And if there's no substantive evidence, if the department is not agreeing to it, then the writ recourse is the only one that is being opted for. And there are several high courts which have said that without giving a reason, you cannot block rate of the taxpayer. So therefore, if at all it is done, then approaching the authorities, and if nothing helps, then filing of writ court remains to be the solution in this case.
Yeah, it seems another controversial provision that we have in the GST law, and we'll have a lot of petitions going around.
That's true.
Yeah, taking up the next point, which is inverted duty structure, I dare say it was controversial. The Supreme Court has had the last word, so to speak, and the Supreme Court has effectively maintained that there is a distinction as far as inverted duty structure is concerned, the refund for it, between goods and services. So there is a distinction that can be made. There'll be an intelligible differentia that is possible, and the government, the legislature, has a lot of latitude, and they exercised their sort of latitude to allow credits in respect of situations where it was concerning goods, but not where it was concerning services, input services. Now, be that as it may, that's the position, that's the law declared by the top court of the country. And the situation is you cannot take and you cannot take and get a refund claim of that component which is concerning input services. So what do you do? What are the possibilities that need to be looked into? There are some thoughts, and they may fit into some situations depending on the business model and depending on the commercial structure. But is there a price variation that may be made? Is there a supply stream alteration which could take place and therefore enable unlocking of the credits that are there for services? Or there are some charges which, if then charged, would enable the offset for the credit that emerges out of the input services. These are some of the aspects which may need to be evaluated, given the fact that this is the ruling and this is the judgment now that is law of the land. One other part which the Supreme Court left open and said that it's for the council to look into is the formula which in Rule 89 provides for how the refund should be computed and allowed. And certain anomalies were pointed out, court appreciated those, and has directed that they be taken to the council for the council to rethink it and reorient the rule if it thinks so fit. But in the taxpayer side, in the meantime that the council may get into it or the government may sort of amend it, there is another step which needs to be evaluated is in the manner and the timing of how you take your credits for goods and services, so as to maximize the sort of output you get in terms of refund from that refund rule. And that timing can maybe play some role in determining what is the benefit you draw or how much it goes up or that kitty doesn't swim. So these are some thoughts that we thought we should share with you all in respect of inverted duty structure, where now we have the judgment and we have to live with that as a position of the law of the land. So with that, we've sort of covered the ground that we intended to. We'll take up the questions now that have come to us. We will take up those which have come to us in the chat box first, and if there is some time, we'll maybe even allow people to voice their questions. Kuraj, you want to begin?
Yeah. So the first question that came up was, you have unutilized credit, but the reversals under 42 has not been made on time. So whether there will be an interest implications, if yes, at what rate? So I'll take that up. So in our view, interest would be applicable because those are different provisions. even if the credit is there, that should not really impact, and interest at 18% would be applicable. Second, I'll take is the question is, what is recent development of on input tax credit as regards to motor car repairs and maintenance expenses? So, Ruturaj, you want to take that up?
Sorry, can you just say that again?
So, input tax rate on motor car repairs and maintenance expenses.
Yeah, so if we look at the restriction of 17.5, it says that services relating to a motor vehicle are ineligible. There was a change wherein motor vehicles beyond 13-seat capacity had become eligible. So looking from that perspective, if the repairs are in relation to an eligible motor vehicle, then the credit of that should be eligible. Otherwise, it will not be admissible.
Fair enough. The third question that we have is sorry, there was a question that you have a certain dress code we have a certain dress code that needs to be given to peer, and there are expenses on clothing material and stitching charges. So whether credit on such expenses would so be available or not?
So credit on uniforms, basically.
It's uniform stitching charges specifically.
Yeah, so I think this has been, typically the position around this is that while uniform is used by an individual, it need not be considered as a personal consumption, and credit on that should be admissible because it is, having a uniform is part of the business practice. The expenditure is done very much in the course of business. Therefore, credit on that should be available. It can very well be questioned by the GST authorities, but I think there are enough and more grounds on the basis of which that credit can be defended.
Sure. Last question, Ruturaj will have it, and this is again on you only, that if the September return is filed belated, so can the past rates be taken or not?
See, that's a little controversial. I mean, because if you look at the provisions of the law, it talks about timelines of credit, and those are linked with the due dates of returns. So if I have a situation where that due date itself gets extended, that's a different thing. Whereas if I am filing return beyond due date, that's a different scenario. So if we are filing GSTR 3B delayed, we are only inviting litigation. So as far as possible, and when we are well within the timelines, the GSTR 3B in fact needs to be filed on timeline, so that you are ruling out any possibility of litigation.
Fair enough. Fair enough. I think we can take the balance question over a mail communication or other thing. Ranjit, would you want to have a closing remarks done?
No, I think we've covered a lot of aspects, and I dare say there are quite a few more aspects. Not few, I think there are quite several number of aspects which one can get into in respect of input tax credit. It may concern capital goods, for example. They may concern certain type of expenditure where there is a connection that you could make to a certain set of provisions and regulations, and so on and so forth. And there are several, I think, other interpretational aspects, namely the one that is most prominent in my mind is the one on the colon and the semicolon, and then should you start denying credit all around on that basis. So I think the people on this webinar should be conscious of the fact that input tax credit is intended to avoid the cascading, to mitigate that tax on tax impact, and therefore it's an important area to take a conscious evaluation of the position in your business, and then sort of move ahead. There are a lot of advanced rulings which come on a daily basis, and it may seem that most of the credit is not allowed, and make one wonder why they're even wasting time going into an advanced ruling when it's going to say that credit is not available. But I don't think we should leave it at that. the evaluation must happen in a professional manner by looking at the provisions and in the context of your business. Yeah. So having said that, thank you to all our participants today, and thank you TAXSCAN team for having us over to share our thoughts.
Thank you so much, Ranjit, Kulraj, and Prithviraj. It's been wonderful to associate with DHRUVA Advisors this time. Hopefully, next time also we'll come up with a very interesting topic soon. Thank you so much. Thank you so much, all the participants and the panelists. Thank you.
Bye-bye.